Index funds are a type of investment that track a specific market index, such as the S&P 500 or the Nasdaq Composite. Unlike actively managed mutual funds, index funds aim to mirror the performance of the underlying index, rather than trying to outperform it. This passive investment approach has gained significant popularity due to its simplicity, low costs, and consistent long-term returns. By investing in an index fund, you gain exposure to a broad range of companies or sectors, reducing your overall risk and ensuring your portfolio is well diversified. Index funds typically have lower management fees compared to actively managed mutual funds, allowing you to keep more of your investment returns. Over the long term, index funds have often outperformed actively managed funds, thanks to their low-cost structure and the efficient nature of the markets they track. Index funds can be classified into different types based on the market index they track. Some of the most common index funds include S&P 500 Index, which tracks the performance of the 500 largest U.S. publicly traded companies. Total Stock Market Index, which mimics the performance of the entire U.S. stock market. International Index, which tracks stock markets outside the United States. And Bond Index, which mirrors the performance of a bond market index. When selecting index funds for your portfolio, consider your financial goals, risk tolerance, and investment time horizon. Compare the expense ratios of different index funds to minimize the impact of costs on your investment returns. Look for index funds with a high degree of tracking accuracy, meaning they closely follow the performance of the underlying index. Aim to create a diversified portfolio by investing in a mix of index funds that cover different asset classes, sectors, and geographic regions. The appropriate amount to invest in index funds will depend on your individual financial situation, risk tolerance, and investment goals. Many financial experts recommend allocating a significant portion of your investment portfolio, such as 60 to 80%, to index funds, with the remaining portion allocated to other investment vehicles, such as individual stocks or actively managed funds. Open a Fidelity brokerage account by visiting the Fidelity website and following the prompts. Fund your account by transferring money from your bank or another financial institution. Research and select index funds, considering factors like expense ratios and tracking accuracy. Place your buy order through the Fidelity trading platform, choosing to invest a lump sum or set up recurring investments. Regularly review your portfolio and make adjustments as needed to maintain your desired asset allocation and risk profile. Open a TD Ameritrade brokerage account by visiting their website and following the account opening process. Fund your account by transferring money from your bank or another financial institution. Research and select index funds, considering factors like expense ratios and tracking accuracy. Place your buy order through the TD Ameritrade trading platform, choosing to invest a lump sum or set up recurring investments. Regularly review your portfolio and make adjustments as needed to maintain your desired asset allocation and risk profile. While both index funds and mutual funds are investment vehicles, there are some key differences. Index funds follow a passive investment approach, tracking an index, and generally have lower fees. Mutual funds are actively managed by a fund manager, which can result in higher fees and varying performance. The choice between the two depends on your investment goals and risk tolerance. Some believe index funds are boring, but their consistent long-term performance and low-cost structure are significant advantages. Index funds are not just for beginners, they are suitable for investors of all experience levels. While index funds aim to match market performance, some have outperformed their benchmarks over time due to low fees and efficient management. Choose index funds with low expense ratios to keep more of your investment returns. Invest for the long term and resist the temptation to time the market or make frequent trades. Automatically reinvest any dividends earned from your index fund investments to take advantage of compounding returns. Stick to your investment plan and avoid making emotional decisions during market fluctuations. Investing in index funds is a powerful,